G'day traders, it's a tough market out there. You don't need me to tell you that. You know, a lot of you have felt that in the portfolios. You can see it there for yourself with the market. The S&P trading at year-to-date lows. You know, people have been selling any kind of rally there, getting into cash positions. You know, you've seen that in the FLUMFO data where $81 billion last week was put into money market funds, which I think probably supported the US dollar. You saw, you know, the record outflows of equities last week. You know, 45 billion out of all equity funds and fixed income funds, and certainly, you know, people are moving into cash at the moment. You've seen that LIBOR rate pushing into 280, which again really just feeds into the idea of tighter financial conditions. You know, global growth, I think, is the #1 issue at the moment. I think there's three major factors that really need to change before we can start seeing a stabilisation and a better feel to these markets. And as I say, global growth very much at the heart of this situation. I think what started and what everyone was focused on with the US-Sino relations and the potential trade tensions that were playing through has morphed into something much larger than that now. I mean, we've seen European growth under pressure for some time. That really played out on Friday where we saw that terrible European PMI number playing through, French PMIs, the new export numbers coming through, the new the new orders component really falling off a cliff. And that's before we really see the impact of the Yellow Vest movement protests really playing into the French economy as well. You've got the IFO numbers coming through tonight in Germany, and if that continues to deteriorate, you know, we will be talking about a recession in Germany when they report their numbers on the 14th of February. We're talking about China, you know, where on Friday, again, you know, you saw their retail sales numbers coming out at the lowest level since 2003. You've got their industrial production lowest level since 2008. They will address that in this week's annual economic conference in China, and potentially they'll look to target 6.5%. Market necessarily won't believe that. I think the consensus is that we're going to see China growing 6.1% in 2019. But of course, we are looking there, and of course, we've seen, you know, various vulnerabilities in the US economy, specifically in investment with oil price now below $50, and that will have a negative impact on investment there as well. We've seen the Fed talking about that like quite actively. You know, home builders have been under pressure for some time, and we continue to see you know, duress in that side of things as well. And of course, you know, you've seen the Empire manufacturing numbers you know, deteriorating to the lowest levels for some time as well. So it's not just China, it's not just Europe. You know, you're seeing that in the US as well, and you know, Australian GDP number was quite weak recently as well. So this is a global synchronized slowdown that is concerned equity investors. You know, it's the same in the credit markets, where you've seen high yield credit spreads blowing out to 350 basis points above investment grade. You know, talk out there that you know, through the month of November, that no company came out to market in the high yield space and issued high yield debt. I mean, that tells you something about sentiment. It is shot to pieces at the moment. You know, we don't even have a high level of short interest in the equity market to fall back on and cause that covering. The second point, and so with that in mind, I think we do need to start seeing changes to global growth, and that's necessarily not going to come anytime soon. The second thing is the central bank reaction function. We all know that the ECB have come now to a situation where they've labelled downside risks and downside momentum in the economy, and it doesn't look like they're ever really going to raise interest rates in that side of things, despite a lot of people believing that in 2019 we will start seeing signs of green shoots coming back through and a change through in their economy. I think we need to have a look at what's happening in the Federal Reserve, and I really don't see this week's Fed meeting being that panacea, that situation that causes a reversal of fortunes. Yeah, we've come to a situation where interest rate pricing has really come down. You know, 18 basis points of tightening in 2019. We're not even pricing in one rate hike in that situation. You've actually got a 35% chance of a rate cut coming through in 2020. So the Fed won't have to just be dovish. They'll have to be uber dovish to meet that kind of market pricing. Yeah, they're going to come closer to the market, but the market is expecting something pretty punchy. Corporate CEOs are expecting a recession in 2020. And so the Federal Reserve not only need to come to a situation where they're going to raise rates in December, but they indicate a long-term pause and be thoroughly data dependent. But also we need to start thinking and addressing the idea of what happens with the balance sheet. This is not me saying this. This is a lot of people out there who are coming from very strong positions of power within the investment community. Stan Druckenmiller, you know, you've got Jeffrey Gundlach, you've seen Paul Tudor Jones, all talking about what's happening with the idea of raising rates at a time when you've got the Fed looking to continue to take liquidity out of their market with the reduction in their balance sheet. So it looks pretty clear that I think in 2019 there will be an active debate about that balance sheet and the idea about what levels they should be looking at, and whether or not we are going to see a situation where their balance sheet runoff will completely abate, and perhaps, they could actually look to stabilise that balance sheet and actually more actively look to increase liquidity through these markets as well. And I think that balance sheet is going to be something that will be a circuit breaker longer term. And I think the other big point is really what happens with the US dollar in 2019. We need to see a weaker US dollar, and in that situation you're going to see a lot of stranglehold that's come through in emerging markets start to reverse. I think you're going to see reverberations playing through in the commodity markets. Gold will certainly benefit from that situation. I like being long gold for 2019. The US dollar is expensive at the moment. We know there's a potential funding issue playing through, the twin deficits and the ever blowing out fiscal deficit that's playing through, and the idea of what's going to be happening in funding, and the idea that the primary dealers are going to be playing a much stronger role there as well. But whether you're looking at the real effective exchange rate, whether you're looking at purchasing power parity on an OECD model or a Big Mac index, the US dollar is expensive, specifically against the yen, specifically against the pound, and specifically against the euro as well. And I think that will mean revert as we go through this time. We can also have a look at the yield differential and specifically have a look at the front end yields. Let's have a look at 2-year yields. US Treasury 2-year yields have been really moving or underperforming against German, Japanese and Australian bonds for some time, and that's really allowed investors to be paid to be long US dollars through that carry mechanism. Now we are starting to see that yield differential decline, and I think that's something that we need to look out for 2019. Specifically, in Europe, if we do see that 2-year, that 5-year, the front end moving down, so that yield differential moves down, it's going to incentivize people to move out of US dollars. A lot of people have been buying US assets unhedged and perhaps increase those hedging ratios and regurgitating some of those US dollar exposures. But I think there will be a weakening effect that comes through in the US dollar. Now I like gold predominantly because I think a lot of these dynamics are not necessarily going to change until we start seeing the big circuit breaker, which is liquidity being fully addressed. But I like the idea that the euro is still not going to be that attractive. The pound potentially could be more attractive, but let's see what happens with Brexit. The yen, we like dollar yen lower for 2019, but with the Bank of Japan, we'll still be throwing everything and the kitchen sink at that situation. And then you can have a look at what's happening in the Scandies, which are really just a proxy of euros. And we say gold will continue to be a standalone currency, the best house in a bad neighbourhood. And that's what we like. We like the eclectic mix of falling real yields, yields differentials converging and therefore the US dollar falling, higher volatility or continued volatility. And until that liquidity issue addressed, I think gold's going to do pretty well, and that's where I'm going to be looking for outperformance in 2019.